battling the relentlessly negative doom and gloom news media. It's the Nick Stenger Show, coming to you live from the Stenger Family Office headquarters. It's your host, Nick Stenger.
All right, everyone, welcome back to another installment of the Nick Stenger Show. My name is Nick Stenger. We are Stenger Family Office. For the past 43 years, the Stenger family has made it our mission to deliver both clarity and confidence to help secure your financial future. We just wrapped up a wonderful series of lunch events here in Houston. That's where I'm at today, flying back home very soon and wrapping up the year very quickly. Some of you don't know this, but we are quickly expecting in the Stenger household baby number 2, having another little boy here in a few weeks. And so just wrapping up the rest of 2024 as you are as well. We just want to wish you an advance Merry Christmas. Hope you had a wonderful Thanksgiving and are enjoying the last couple weeks of 2024. We will be reaching out to you, many of you, very, very soon for either year-end calls and also beginning of the year calls in 2025. Hard to believe we're going to be in 2025 very, very soon. And aren't you glad you stayed on your plan? That's what we've tried to do for you here at Stenger Family Office with the shows, with the podcast, with all the events that we put on. We just want to keep you on your plan. And that's where we're at today. So as it stands right now, year to date, the S&P is up over 28%. Unbelievable. I didn't expect that myself, quite frankly. We came out at the beginning, or really at the end of 2023. And in our market outlook webinar, which we'll be doing very, very soon, I think it's going to be next week that we do the market outlook show, or maybe the week after that. So keep an eye out for market outlook 2025. But in our outlook for 2024 in December of 2023, what did we say? We said stocks were going to go up, and we said 5,200 on the S&P, and we blew way past that. And here we are today, and we're almost at 6,100 points. The NASDAQ over 20,000 for the first time ever. And it just is a testament, in my opinion, to what's really going on underneath the surface of the economy. And it's not to say everything's perfect. It's not to say that there won't be problems ahead. It's not to say that we're not going to have a correction. And in fact, I would tell you, I think we're probably due for a correction. I think we are going to see something like a 10% correction here next year. We typically don't get a 20% correction unless it's a recession, which I think we're going to avoid again. I think we'll avoid recession in 2025. But I do think just be prepared despite a correction. When the media comes out and says, with all the doom and gloom, this time's different, this is the end, this is the time to panic and sell everything, I just think that's going to be wrong. I think that's not correct. And I think instead we're going to see some recovery pretty quickly after any correction we have. And then I think we're going to go on to make brand new all-time highs. Now, we will give you our market outlook. Like I said, I'll tell you my exact prediction for the S&P for 2025, which again is based off of 2026 profits. So we are no longer worried about 2024 profits. We're no longer worried about really 2025. We are worried now, and we're looking towards 2026 profits. And you're starting to see a ton of widening out. We call it market breadth. And that's a very good thing. We're seeing stocks like Williams-Sonoma up 70% for 2024. Walmart is up in a big way. JP Morgan is up over 30%. Companies that are not in the Mag 7, companies that really don't have much to do with AI. Maybe they're going to embrace some AI, but they're not AI companies, and they're blowing the doors off their earnings. And so I think what you should do is just make sure you don't get wrapped up in this narrative that it's only 7 stocks driving the market, that it's only the Mag 7. It's just not, it couldn't be further from the truth. In fact, the Mag 7 have not really worked out all that well this year. It's been a large cap rally, a large blue chip companies have done well, which I predicted. I think that will continue to be true. Part of the reason for that is only because I think they just have such good business models. And I wrote about this. I talked about this, I believe, last week as well, where I said Microsoft, where they used to sell you the floppy disk or the CD-ROM with the software every 5 years for $50, was not that valuable. Well, now what do? On an enterprise plan across a Fortune 500 company, Microsoft is selling their 365 at $90 a month That's reoccurring revenue. It's very profitable, and they're growing that revenue. And by the way, good luck trying to do your job nowadays without Microsoft or without AWS from Amazon. That's Amazon Web Services with their cloud business, and Google and all the other companies that we have in the portfolio that are critical infrastructure. And so just like back in the day, an infrastructure play would have been roads and bridges and manufacturing and all the rest of it, which is still very important. A lot of the new economy infrastructure is technology. And so, again, none of this is stock advice on an individual level. But as an example, NVIDIA, in my opinion, is the pipes and wires. It's the infrastructure for autonomous. And it's not really all about AI. You read the stories about AI, and maybe you've used Chat GPT and you've gotten some cool experiences there. But it's not really about that long term. It's really about quantum computing. That's what NVIDIA has done. And because they are the place, and really the only place, that other companies can go for this quantum computing power, they're off the charts. They're back ordered for many, many years, and they can charge whatever they want. And at some point, will NVIDIA have a 30 or 40% correction? Sure. We've had that a few times in the past. Should you have 30 or 40% of your portfolio in it? No, of course not. But as an example, these companies like NVIDIA that are up are not just up on a fugazi, woozy wazi. They're not just up because multiples have expanded, because earnings multiples have gone up. They're up because earnings are up. And so in the late 90s, which a lot of people have compared this time to, they say, Nick, this is just like the late 90s. This is a bubble. And so the episode today is called When Will the Bubble Pop? And first of all, I just want to make a comment and say, I don't think we're in a bubble. So first of all, no bubble. Number two, if you don't have a bubble, you're not going to have a pop. It's not going to burst. Now, does that mean the whole market, every single company in the S&P 500 is perfect and not overvalued? No, of course not. I could name 5, 6, 7 names that I think are dramatically overvalued that we should be careful on. And we wouldn't want to own for clients right now. But I can also name a lot of companies for you that are value oriented, that are dividend paying, that are growing profits, that have increased their dividends for 50, 60, 70 years in a row, called dividend aristocrats. And those stocks, in my opinion, are undervalued. And so don't get wrapped up. Don't, like I said the other week, don't get lost in the sauce and the noise of the whole market's in a bubble, because I just don't think that's true. By the way, functionally speaking and operationally, think about what happened in the late 90s. 1992 was a phenomenal year, even 91, 92, 93, 94, 95, 96, 97, 98. All those years leading up to the bubble were just unbelievable years. It wasn't until the bubble burst that it became problematic. What happened in the 90s was price multiples, PE ratios were expanding, earnings were not. But you got just incredible amounts of growth leading up to that burst. You had 7, 8 years of just phenomenal returns before everything fell apart. And by the way, everybody just wants to talk about the lost decade, which is 2000 to 2010, where you had the bubble burst in the 90s or 2000. And then again in 08 and 09 with the financial crisis, where stocks really didn't do a whole lot of anything, at least U.S. cap-weighted stocks. But the reality is that's not really how it works. It's that people had invested in 92, 93, 94, 95. And if you had gotten invested in 1992 or 3 or 4 or 5, and you just held on through that entire cycle, through 05 and 06 and 07 and even 08 with the big financial crisis, you ended up okay. You actually ended up with annualized returns over that decade. Pick any decade you want, other than starting in 2000. And the market is up, 7-8% a year with the dividend. So you can't try and time this thing. So then I get the pushback, Nick, I get all that, but is this 2000? Am I buying at too high a point? Am I paying too much for the S&P? Maybe I should sit on some cash and wait for a big correction before I get my money to work. And I would just say, be careful with that, because right now, today, you are paying 24 times current profits. You're paying 24 PE for the S&P on a current basis, but on a go forward basis, remember, looking at 2026 profits now, you're only paying about 20 times earnings on a go forward basis. And because of that doesn't tell me the stock market's radically overvalued. In fact, I think we've got some room to run. Now, a lot of the room to run is probably baked in. A lot of the return that we were going to get this year has already started to price itself in because we had the election a few weeks ago. The market just wanted some certainty there. Plus, I think the market thinks the policy is going to be good, especially on the fiscal side of things. So all these things are starting to add up to be, we've got some growth ahead. It just may not be 27% growth. And that's my other advice to you, is just don't have FOMO of, the market was up 27, 28% in 2024. And if it doesn't go up 20% in 2025, that's a huge bummer. That's a terrible year. That's not correct either. If you get to high single digits or low double digits next year, that's amazing. That's a phenomenal year. So even if you have a 6-7% price return, remember, S&P dividends around 1.5%, 1.7%. You may add some of these numbers up and be at an 8% return next year. So again, I'm not guaranteeing anything. I'm not saying this is going to happen for sure exactly at the time that I think it will happen. I just think the odds are in your favor. And so when everybody is starting to get nervous and bearish and worried and thinking the market's overvalued, that's when we want to be bullish. We want to be contrarian in that respect, and we want to be optimistic. And so there's a famous quote. I'm going to butcher it a little bit, but it's essentially that bull markets are born on pessimism. They mature on skepticism, and they fall apart on optimism. And I don't think we're anywhere close to the entire market being exuberant or bullish. I had a client tell me yesterday, he goes, Nick, the only thing that I get worried about is you're just so optimistic. And I almost wanted to say back, I wanted to say, well, I'm worried that you're too pessimistic. If you had to pick one way to be for the past 200 years of market history, well, you'd have wanted to be a bull. You'd want to have been bullish. The bears sound smarter. You listen to these people on CNBC or Fox Business, and they sound very intelligent. They're going to tell you why the world's falling apart, and they'll give you 10 reasons why, and they'll throw a couple of big fancy charts up, and they're going to tell you, here's why, PhD from MIT says the world is going to end tomorrow. And it's just like it sounds so cool. It sounds so interesting, so intelligent. But if you actually looked at these people's track record, if you looked at the Bears' track record, you would have made zero money. And you might have even lost money by listening to what they said. In fact, if you listen to the hedge fund people, which are incentivized to be bearish, remember what hedge fund managers do. They want to hedge the downside. So for them to raise a bunch of assets and make a lot of money, remember they charge 2 and 20, 2% management fee, and then 20% of your profits. For that to work as a model, they've got to have a bear market. So what are hedge fund people always rooting for? They're always rooting for doom and gloom. What are the long-term bond fund managers rooting for? They're rooting for doom and gloom. They're waiting for a pullback. And if you actually listen to them, like Michael Burry, the Big Short movie that was made on him, where he successfully called 08 and 09, and he was right. He said to sell stocks at the beginning of 2023. Well, the market's up 57% since he said to do that. So you just got to be so careful of what you're listening to and who you're watching, because chances are, if you're watching the bulls, the optimists, the actual managers of money, not just strategists and timers and traders, but you look at the people like us who are incentivized to keep you on a plan, we've been right more than we've been wrong. And that's because the stock market and just markets and capitalism and economics in general favor optimism. The economy isn't just a collection of companies. The economy is not just a collection of data points. It's a collection of people and companies where we have just the smartest people. We have some of the brightest minds. I was saying this today at one of our lunch presentations. I'm just amazed at the kind of people that we interact with. They're just so intelligent. They're so bright. They've got just the best innovation and so many good ideas coming in the pipeline at all these different companies across Wall Street. And you look at that and you hear these stories and say, how could you be a bear? How could you be pessimistic when you see what's coming down the pipeline. And so it's just exciting when you hear these stories. We're seeing more and more cancer being detected more quickly now, thanks to AI. We're seeing people live longer than ever before because the stock market is at record highs. Americans are giving more money to charity than they ever have. And we're lifting the rest of the world out of poverty to the tune of, we have the lowest level of people living in poverty than ever before. We have more people that are literate, that can read and write than ever before. And we are getting the internet to places on Earth you never thought it was possible. One example of this is Starlink from Elon Musk. And we're projecting satellite internet in to communist countries where it's not here right this second today. But I think eventually what's going to happen is it's just going to unleash democracy and prosperity on a level that we just haven't seen. And it's all thanks to innovation. It's all thanks to technology. And guess who's making that technology better? Entrepreneurs, innovators, people like us that just go to work every day, come up with new ideas and turn those ideas into businesses. And so if you believe in that story, if you believe in the resilient American spirit like I do, you're just going to be an optimist. And so it's not to say we're not going to have corrections. It's not to say we're not going to have problems or slowdowns or bumps along the way. But I think when you look back a year from now, 5 years from now, 10 years from now, you are just going to be so happy you stayed in your U.S. equities in particular. So I would just encourage you, stay the course and don't buy into this doom and gloom narrative. Be prepared mentally for a correction. But like Warren Buffett said, just stand there, don't do anything. Human nature is to say, don't just stand there, do something. Well, in investing, it's the opposite. It's don't do anything, just stand there, be patient. And what happens over time in the markets is patient people get rewarded. They earn more money because they stayed in their stocks, and they reap their net worth increases because the pessimists and the impatient people panicked. That's all it is. Somebody is panicking. Somebody who's impatient is selling their stocks to somebody who's patient, and the patient get rewarded over the long run. So be in that group and stay bullish. So we will wrap up the show a little early this time. I just want to give you a couple of insights into what's coming next year. Number one, we are going to try and knock out a bunch of new shows. We were a little bit behind this year, and I think we only hit maybe 35 or 36 this year. We're going to try and ramp that up. So keep coming back to the Nick Stenger Show. If you haven't subscribed yet, make sure you do that. If you're watching on YouTube, subscribe. It helps us get it to more and more people. We so appreciate that. Number two, we continue to do our lunch and learn events. We're going to be back, I think, about 5 or 6 times in Houston. We may start doing a few in Naperville, where we talk about all sorts of topics like estate planning and taxes and investments and financial planning. We've got a big overnight event, so a mini version of our Wealth Insights Forum that's going to be at the Four Seasons. This is for all of our people who want to come down to Texas with us. And we're going to have a half-day event at the Four Seasons in Houston. And then we're going to follow that up and bump up Investor Day next year to October. And I believe it's October 9th and 10th is the tentative date. It may change, but just make sure you've got your time blocked in October of next year if you're going to come up to Naperville for our usual Investor Day. I think this one actually might be in Oak Brook, so just right down the road from Naperville. And so we are just so excited, ready to bring you the clarity and confidence next year, the data, the good news. And so stick with us here. Come back in a few weeks for the Christmas show. We've got a nice surprise for you on that. We'll do one more episode of Bullish before the year is up. And we can't wait to see you on that as well. Thanks for being here. We'll see you next week for episode 170.